movement that's gained a lot of traction recently is the FIRE movement. Tell me what FIRE stands for, firstly, before we kind of get into the crux of it.
Yeah, Cliona. So FIRE stands for Financial Independence, Retire Early. And it's a movement that's kind of gained a lot of traction in the US and now kind of in parts of Europe and obviously Ireland. And people do need to be conscious that a lot of the stuff they read online when it comes to FIRE is more based on the US system. So it's not always, I suppose, relatable to the systems that we have in Ireland, the tax systems. You hear a lot of US based materials talking about setting up limited companies and doing things quite tax efficiently. Some of those things aren't really available in Ireland, but in its purest form, really, Cleaner, it is, you know arguably living quite frugally, getting by on a very small percentage of your salary or income, saving and investing a very high percentage of your income regularly. So you're trying to kind of build up a pot of money or build up enough wealth to retire a lot earlier than a typical retirement age for people that pursue FIRE in its purest form. Some of them are looking to retire even in their as early as their 40s.
And like, what does financial independence look like for somebody? So, is there any kind of statement that kind of, you can refer to that explains what financial independence is? So it's like,
Yeah, financial independence for me is reaching a stage in your life where you review your financial situation, look at your assets, and have enough assets built up to replace your income so that you don't have to work. Now, whether you choose to work beyond that is another story, but it's more that you would choose to work rather than have to work based out of financial necessity. So there's a couple of things that you need really to be financially independent. You need ideally to have no debt, certainly no short-term debt. You need to have a stream of income to meet your living expenses, whether that's drawdowns from a pension fund, an investment property, drawings from an investment portfolio, or maybe a combination of all the above. Ideally having a separate pot of money to maybe look after things like maybe money for your kids, getting your kids through education.
it seems like a really kind of aggressive stance to take. And, you kind of think, okay, like living frugally, you've got to enjoy life as well. I mean, obviously we work to enjoy life and to have money to provide for whatever, whether it's children, family, but like bring me back to what the basics of FIRE actually are. So what are the basics around it? And, I know people talk about this kind of FIRE number. Are there different elements of FIRE other than this really extreme approach, I suppose?
Yeah, absolutely. Like I was quoted in the Examiner a couple of weeks back that I'm not a fan of FIRE, and it's not that I'm not a fan of FIRE. I'm just not a fan of it in its like purest extreme form, which is living frugally to retire in your 40s. Because as you rightly pointed out, it's important to live life, and there's this balance between obviously planning for future needs, but enjoying the now as well. So even though it can be really extreme, there are some really good lessons that FIRE teaches us, like, maximizing our pension contribution, saving and investing, trying to reduce any unnecessary leakage, trying to become debt free, reviewing your expenses is a big thing, looking at your mortgage rates, looking at your electricity bills, looking at how you're spending your money to try to free up more disposable income or free up as much disposable income as possible to allocate to kind of future and savings and investments. And it's kind of having that financial plan. But there are different variations of FIRE. So, for instance, like financial independence is an objective that most of my clients share, but for some of them, it's maybe retiring at 60 or
Mm.
retiring at 55, which I would still see as a form of FIRE because it's retiring a lot earlier than maybe the typical age people that would retire at, that might be say 65 or 66 once the state pension kicks in. So you can follow the steps that FIRE lays out without having to focus on being able to retire in your 40s.
And, I suppose I'm just thinking now, can somebody kind of go into that semi state FIRE whereby, let's say, at 50, 55, they still have kind of income streams and they're still kind of dipping their toe in the water as such when it comes to kind of earning money, but they're not full foot to the pedal in terms of, working full time.
Absolutely, Cleta. Yeah, and it's about having that kind of financial plan. And I talk a lot to clients about this kind of phased retirement approach, and it's something that a lot of my clients do. Where maybe, let's say, at 50 you decided to, or 55, let's say, you decided to take life a little bit easier, maybe go back to 2 to 3 days a week in your current role, and maybe draw on some pension fund that you had left over from a previous employment, or maybe start drawing some money down from an investment portfolio. Then maybe at 60 you kind of fully hang up your boots from your current job, start drawing from that pension to give you more income between maybe 60 and 66, and then 66 your state pension kicks in. So it's about kind of looking at your assets and seeing how they can be drawing down to get you through various kind of stages of your retirement journey.
And would you have, let's say, people coming into you as clients, be it, somebody seeing you on their own or as a couple, coming in to kind of find out what that number is for them based on their kind of current earnings?
Absolutely, yeah, yeah. Everyone has, a number that they need to replace their incomes basically, or reach financial independence. Now, it's important to note that it is varied because look, we all have different spending habits and lifestyles and stuff like that. There is some good rules of thumb, like you hear a lot of people talk about the rule of 300, which is basically whereby you multiply the amount of income that you need on a monthly basis by 300, and that would be the pot of money then that you need to accumulate to reach financial independence. So if I'm somebody who calculates that I need to get by on €3,000 a month, multiply by 3,000, that would translate into a €900,000 pot. It's not always as easy as that then as well, because we have different situations and you need to factor in inflation. But the idea is that if I take 4% per year from that €900 pot, that would give me income of €3,000 per month for hopefully the rest of my life.
Yeah, I mean, and will that pot sustain you for however long you may live, after that magic number that you've been kind of set as your goal, your fire number, let's say?
Yeah, and that's why it's important to have kind of a comprehensive financial plan, because there's no point saying that, okay, I need 900,000 euro to reach financial independence, but then suddenly you're still left with a mortgage for another
Yeah,
10
yeah, yeah.
years, or you have kids that are going to college education 5 years after your point of financial independence, and you've no plan for them. So it's about, having a
But I
different strategy there.
presume like fire is where all of those, like your mortgage has been paid off, your children are, finished in kind of full-time education. Is that true or?
Not necessarily. I mean, like you can incorporate that into your plan. Like, so I you might have a strategy to build up enough wealth by say 55 to, even if your mortgage is naturally going to 60 or 65, that part of the plan would be that we could release a lump sum somewhere to get rid of that, and we could also have this separate pot to get the kids through education. So it's not this case that we need to wait until our kids are out the other end of third level, or we need to wait until our mortgage is naturally paid off.
And David, there's probably a lot of people listening to this saying, oh my God, I can't even imagine, because it is kind of unimaginable in a way to kind of think, okay, at 45, 50, I'm going to have enough money to sustain, a lifestyle for the next however 30, 40 years. I suppose we're in kind of times whereby people sometimes are struggling to even get on the property ladder.
Yeah.
Like, is this only for high income earners?
Yes and no. As I said earlier, everyone has different kind of, lifestyles and spending habits and situations. Like, I've clients who are earning, massive six-figure salaries that are struggling to get by, and I've clients that earn very modest incomes that are maxing out their pensions and have loads of money in savings. Because we all have different, lifestyles and obviously situations. Some people might be a bit lucky when it comes to money as well. So yeah, it can really differ, but try not to get too bogged down and just, start small. As I said from the outset, there's some really good messages that fire teaches us. Review your
I
expenses,
was just
look
going
at
to
how
say, what
you're.
are they? Like, if you were to kind of go through some of the
Yes.
simple things that people can start with.
Okay, so I suppose you could say that there are a couple of, I suppose, key starting points. Okay, so firstly, you want to maybe establish a bit of an emergency fund, so that would be
And
different
how much
amounts
does
for.
somebody need in an emergency fund?
A good rule of thumb would be to have maybe 3 to 6 months of take-home pay in some kind of fund that you could draw on, and that would mean that if the car breaks down or the boiler breaks or there's some kind of financial emergency, that you have that pot there and it doesn't upset your kind of longer term
And where should you
financial
keep
plan.
money like that? what kind of account should you keep an emergency deposit in?
If it's an
Or
emergency
emergency fund,
fund,
sorry.
yeah, if it's an emergency fund, typically just kind of a high interest paying bank account like some of the online banks that we're seeing at the moment. But I would argue to some people that, you don't have to keep 100% of your rainy day fund, because let's say you're an individual that 6 times your take home pay is 40 grand. Do you really need 40 grand sitting in an account doing diddly squat, losing value relative to inflation? So it might be a case where you put 20,000 in, a guaranteed deposit account that's accessible, earning a small bit of interest, and maybe have the other 20,000 in a moderate risk, well diversified investment fund.
So you've said, okay, emergency
Yeah.
fund is the first thing.
Income protection is big as well, and our industry gets, hammered for trying to sell protection products all the time. But income protection is the one thing that's very important, because everything we do in terms of chasing financial independence is all coming from our income. It's us, putting our income to future planning. So if one of us has, I suppose, a shock where we lose our ability to earn that income, maybe due to sickness or an ailment or an injury or something like that, income protection kicks in to replace the income so it doesn't kind of upset our plan.
And I think that's really
Yeah.
important. Like I spoke to a friend recently who is a single parent, and for her, her income is so important. So like income protection, if it's not provided by your company, is something that people should definitely explore.
100%. It is probably one of the most important, plans or policies that our industry can sell. It's the starting point, or it's the kind of, I suppose, a fundamental part of any kind of solid financial plan. And it's not that expensive,
I
and
was
there
just
is
going to say,
tax
like,
relief
what
on the
does it cost somebody
premiums.
per month approximately?
It can differ. I mean, like you probably pick up a good bit of protection for 40 to 50 quid a month, and there is tax relief on the premium. So if you're a top rate taxpayer, you might be able to get 40% of that back. But yeah, it really varies depending
Okay,
on how
so
much income.
emergency fund, income protection.
Perfect.
What's the
Then
next
it's
one?
really about kind of looking at how you're spending your money, and, reviewing everything that you're paying for. What mortgage rate am I on? Is it the lowest mortgage rate? What health insurance plan am I on? Can I reduce the cost? Ringing around insurance providers, ringing around electricity, gas, and, oil providers to try to reduce costs as much as possible.
And can somebody talk to you if they wanted to look at reviewing a mortgage policy? Can you give them advice on what the best mortgages are in the market?
Yeah, absolutely. Like there's a lot of new entrants in the mortgage market today. It's not just your pillar banks, AIB, BOI, PTSB. We've a lot of newer entrants there, so there's a lot of competition. And obviously, we've gone through a fairly volatile period in interest rates where they've gone up sharply. Now we're starting to come back down. So I would probably go out on a limb saying the majority of people in Ireland today might be able to find some savings by changing their rates, because either they took out a mortgage in the last couple of years at, really high rates, or maybe, are approaching, the end of their fixed rate now.
So you've
Yeah.
spoken, obviously, mortgage, looking at a kind of insurance policies on top of having your emergency fund, on top of kind of income protection. I read an article the other day about, so much money is being lost in idle kind of savings accounts. So for somebody looking to achieve FIRE, surely like investing and saving in the right vehicle, and pension would be another kind of two big factors as well, would they?
Absolutely, yeah. It's vital to appreciate that your money needs to work for you. You're not going to achieve financial independence using a bank account or a credit union account, or a post office account, because for one, inflation is just eroding the value. You need to make sure that your money is earning a return which beats inflation, but ideally a lot more than that. So our two options there are to invest personally in, investment funds, stocks, shares, bonds, funds, etc., but also invest in those things through a pension. And for anyone that is pursuing FIRE, I would encourage them to try to max out their pension. So we have scope to fund a pension each year relative to our age and our earnings. So for me, I'm in my mid 30s, I can pay 20% of my earnings into a pension each year. And I try to get pretty close to that, because the benefit of investing through a pension, Cliona, is that you're investing your before tax earnings. So for every €100 that I put into my pension, it's only costing me €60. Whereas if that would otherwise, for the same cost of €60 going into a credit union account or an investment fund, I get €100 hitting my pension, which is a 66% immediate uplift. Also, any of the growth that's in the pension, so you talk about investing in funds or stocks or S&P 500 ETFs, all that can be done within a pension, but any of the growth within a pension is completely tax free. So you're getting the benefit of compounded, completely untaxed compounded returns over decades, which is adding rocket fuel to that savings fund. And the point is that you're going to build up a fund and a pension at a much quicker rate than anything else.
So for somebody, let's say, I'm just thinking the likes of, people working in like maybe the tech industry or pharma who are on, high income, maybe salaries that can put money away into pensions kind of earlier on in their careers and build up this kind of fund for their, fire journey as such, is how you do it. And that's kind of how you aim for it. I mean, let's just take everything that happened with Trump recently and the tariffs and everything like that. How would that impact somebody's fire journey, with markets falling and, if people lose money in investments?
Yeah, it's a good question. So for people that are just kind of starting off in their fire journey, people or their financial independence journey, let's call it, for people in their 20s, 30s, arguably even 40s, they don't really need to be concerned. It's important, obviously, to get advice and making sure that the portfolio that you're in is, well diversified. And remember, markets will always have their challenges, and every single stock market decline or crash, as people call them in history, has been temporary. The vast majority of them have always recovered just within 1, 2, 3 years time. And markets are very resilient over time. So if your financial independence point is 50 or 55 and you're in your 30s, the reality is we're going to have a lot of market declines between now and then. So why would you get bothered with what's going on over the last couple of weeks or next year or 5 years time when you're not going to need that money for a very long period of time? Now,
So it's time, really.
it's time, yeah. Time and diversification are the two most important principles of investment success.
Uh,
Right,
Sorry,
yeah.
I don't mean to interrupt you, but I'm thinking, okay, rental property. I don't know whether it's an Irish thing but some people are kind of really keen on buying rental property as a source of kind of passive income, maybe to reach this, to go on this fire journey as well. If they have extra or if they have high income salaries and they want to become landlords. Like, what's your thought process on property and maybe the pros and cons of
Yeah,
it?
I mean, like, firstly, each property needs to be assessed on its own merits because some properties perform very well as an investment asset and some don't perform very well and they actually end up, losing money for people. But the main advantage of a property is it provides passive income. But for people that are in their early journey that are trying to build up wealth as much as possible, they don't need passive income now. What they want is an asset that grows and accumulates in value as much as possible over time. And you're going to do that in, let's say, like an equity fund or even a pension fund, much more efficient than a property, in my opinion, because property, it's not the most tax efficient investment. You need to finance it from after tax earnings. The rental income is taxed probably at 52% if you're working anyway. But for people that are maybe in their fire years, if you can use some of the pot that you've accumulated at that point to buy a property and use the property then to provide passive income down the line, it might fit into your strategy. But I'm not a fan of people doing it early on.
And I suppose just coming back to kind of maybe summarizing the whole fire thing, and like overall, it seems the kind of hard, if you're going to stick to the real fire movement, it seems like you are going to have to sacrifice an awful lot to live very frugally. However, do you think it's achievable for many people, I suppose?
Um, in honesty, today in Ireland, probably not. It's not achievable in its purest form for people to retire in their 40s unless they're very, very lucky. Sometimes it's got to do a lot with your character as well. Like, you meet people and they just say, look, we are very frugal. We don't spend money. We go on basic holidays. We don't go out. We chill out and watch TV and, make home cooked meals. And
Yeah.
because of our lifestyle, we can afford to save and invest quite a lot of money. And then you meet other people that say, we like our holidays. We like going out. We have 4 kids and they're bloody expensive.
Yeah.
So, it
And what
really
would your
differs.
advice be, I suppose, look, for anybody that is looking maybe to talk to you, David, and, this topic has maybe sparked something in them, what would you say to them?
Definitely book in for a financial planning consultation, because like we look at your situation now, we look at your, what your fire number is, or what your magic number is, as I call it, and we'll give you some kind of financial roadmap on how you can get to that in the most efficient way as possible, including kind of reviewing your situation and reviewing that plan on an ongoing basis.
And what's the best way for people to book?
Head over to our website, www.alphawealth.ie, and you can book into either my own diary or my colleague Nick, who's excellent as well. Both of us have quite a lot of experience in the industry and are well used to dealing with people and giving them that kind of tailored financial plan.
Brilliant. Thanks a million, David.
Thanks.